We are getting straight into the machinery today. We are looking at S-381 in the Senate and House Resolution 1944 in the House.
That's right. And collectively, this legislation is titled the 10% Credit Card Interest Rate Cap Act.
It is a piece of legislation that is exactly what it sounds like, but also, as we're going to find out, so much more than just a number.
Oh, absolutely. It's arguably one of the most significant shifts in financial policy proposed in decades.
Before we start tearing this bill apart, just a quick housekeeping note for you listening. Please make sure to hit that like and subscribe button.
It really does help us keep these investigations going.
Okay, so let's unpack this. The headline is incredibly appealing. I mean, credit card interest rates are painful. They are a universal frustration.
Right.
And here comes a bill that proposes a federal price ceiling. It caps credit card APRs at exactly 10%.
On the surface, it seems like a straightforward win for the consumer. You lower the rate, people pay less interest, everyone, keeps more money in their pocket.
It sounds incredibly simple. Lower rates for everyone. But our mission today isn't to debate whether 10% is a nice number.
No.
We are looking at the sources, the bill text itself, the comprehensive impact assessment, and data from the banking and retail sectors to figure out how this actually changes the plumbing of the U.S. financial system.
Because when you read the fine print, the plumbing looks like it might burst. We really need to move past the sticker price of the bill and look at the mechanics.
Right.
Because the sources suggest this isn't just about lowering a rate, it's about potentially restructuring the entire consumer economy.
Yeah.
The ripple effects here go way beyond your monthly statement.
So let's look at the players first. This isn't your standard partisan bickering where one side says yes and the other says no.
Just out of habit. Yeah.
Exactly. The sources highlight a really unique political coalition supporting this.
It is what political scientists often call the horseshoe theory in action. You imagine a horseshoe. The two ends are far apart, but they curve around and almost touch. On one side, you have progressives like Senator Bernie Sanders and Representative Alexandria Ocasio-Cortez. They view high interest rates as predatory extraction from the working class.
They see 25% APR as usury.
Basically. But then you look at the other side of that horseshoe and you have populist conservatives like Senator Josh Hawley.
And President Trump has endorsed this 10% cap as well.
He has. And the motivations are slightly different, though. For the populist right, it's about inflation, cost of living, and curbing the power of massive financial institutions.
They don't want Wall Street dictating terms to Main Street.
Exactly. So
Yeah.
you have this convergence of left and right agreeing on the solution, a hard cap, even if their philosophical reasons for getting there are totally different.
It's rare to see that kind of alignment. Okay, let's get into the text. This amends the Truth in Lending Act, or TILA. What is the core mechanism here? Because a cap is a cap, right?
Well, this is where this specific legal phrasing becomes so critical. We have to pay very close attention to Section 107F1. It says the annual percentage rate may not exceed 10 percentage points.
Okay.
But here is the kicker. And this is the phrase that changes everything. It says it is inclusive of all finance charges.
Inclusive of all finance charges. That seems like a small detail, just some legal boilerplate, but you're saying it's doing a lot of heavy lifting here.
It is doing all the lifting. Under the Truth in Lending Act, a finance charge isn't just interest.
Right.
It is a defined bucket that includes service charges, mandatory insurance premiums, loan fees, a whole list of things.
Yeah.
By bundling everything into that 10% cap, the bill is effectively closing a loophole before it even opens.
I see. So they are trying to prevent a situation where a lender drops the rate to 10% to comply with the law, but then says,
Oh, by the way.
There is a $50 monthly participation fee to make their money back.
Precisely. This language blocks that maneuver completely. It says every penny you pay to the lender for the privilege of credit, no matter what creative name they give it, counts toward that 10% limit.
So if the math pushes the total cost over 10%, it's illegal.
That's it. It's a very tight leash.
And there's a time limit on this too, right? This isn't permanent legislation, at least not initially.
The sources note a sunset provision. These amendments are effectively an experiment. They expire on January 1, 2031, unless Congress decides to renew them.
So it's a 5-year test drive of a radically different financial system.
Which adds a whole other layer of uncertainty. If you are a bank, are you going to overhaul your entire infrastructure for a rule that might just vanish in 5 years?
That's a good point. But let's stick to the consumer side for a moment. As we were reading through the analysis, there was this one section, Section 107F2, that really caught my eye. I had to read it a few times to make sure I understood the implication.
You're talking about the transactor paradox.
Exactly. This is the part that affects the people who think this bill doesn't apply to them. If you are listening and you pay off your credit card balance every single month to avoid interest,
You're what the industry calls a transactor.
right, you need to hear this, because this bill might actually make you a toxic customer for your bank.
It sounds totally backwards, doesn't it? Usually banks love responsible payers.
Of course.
You're reliable, you swipe the card, merchant pays a fee. But let's look at the text of Section 107F2. It's an anti-evasion rule intended to stop banks from gouging people with fees.
Okay.
It states, the total sum of such fees may not exceed the total amount of finance charges assessed.
Okay, let's walk through the math on that slowly. If I am a responsible user and I pay my balance in full every single month, my finance charge is zero. I pay zero interest.
That's the definition of paying in full. Your finance charge is, by definition, $0.
So if the law says the total sum of fees cannot exceed the finance charges, and my finance charges are zero,
Then the bank can charge you exactly $0 in fees.
that effectively breaks the model for premium cards. I'm thinking about something like an Amex Platinum or a Chase Sapphire Reserve.
With those $500 or $600 annual fees.
Yeah. And under this bill, the bank cannot legally charge you that $500 annual fee unless you also pay at least $500 in interest.
But the whole point of those cards is that people who have them usually have the money to pay them off.
They don't carry balances.
Exactly. Which is why the source material calls this a perverse incentive. A customer who pays in full generates no interest revenue. Now, under this bill, they can't generate fee revenue either.
But they still cost the bank money.
Right. The bank pays for fraud protection, customer service, the plastic in your wallet, the IT network.
So the best customers become money losers.
They become a drain on the balance sheet. So banks have two choices. They either hope you start failing to pay your bills so they can charge you fees, or, and this is more likely,
They just cancel your account.
they simply cancel the accounts of transactors because they become legally unprofitable. You could have an 800 credit score, perfect history, and find your card canceled because you weren't paying enough interest.
That turns the conventional wisdom of building credit completely on its head.
I mean, we've spent decades telling people, pay your bill in full, don't pay interest.
Now, the law might say, if you don't pay interest, you don't get a card. It's a classic case of a regulation having a secondary effect that is just diametrically opposed to common sense.
It really is.
But let's zoom out to the broader market. Forget the annual fees for a second. Can banks even operate at 10%? I mean, to the average person, a 10% return sounds pretty good.
It does sound good in a vacuum. But banks don't lend their own money. They borrow it to lend it to you.
Right.
We have to look at the arithmetic of lending. The source material highlights that the prime rate, which is the baseline cost for banks to acquire capital, is currently hovering around, let's say, 7.5% to 8%.
So the bank is paying 8% just to get the money in the door.
Think of it like a grocery store buying milk. If they buy the milk for $8 and the government says they can only sell it for $10, they have $2 margin.
Okay, a $2 margin, that's still profit.
Is it? Because out of that 2%, you have to pay for all the operational costs?
Fraud detection.
Fraud detection is huge. Processing systems. Keeping the lights on. The sources estimate those operational costs are another 2% to 3%.
Wait, so 8% cost of funds plus 2% operations, that's 10%.
You are at a 10% cost. So if you cap revenue at 10%, you are at zero margin. You are breaking even. And that is before we account for the biggest cost in lending.
People who don't pay you back.
Charge-offs. Defaults. Exactly. If even one person defaults, that entire model goes underwater. The industry modeling in our sources suggests that up to 88% of current credit card accounts would become unprofitable under this math.
Because they can't go above 10% to offset the people who don't pay.
The math simply doesn't work.
So what happens to those people, the moderate risk folks?
They get debanked. It's a term we're seeing more and more. The sources indicate that lending would likely cease entirely for borrowers with FICO scores below 600 or even 660.
Wow. I mean, that is a huge segment of the population. What's the estimate on the actual number of households?
The data points to around 14.3 million households who currently revolve balances. These are families that rely on that credit line for emergencies, smoothing out cash flow.
And they would likely have their credit lines cut or closed entirely.
That's what the models predict.
That is a massive contraction. It's essentially removing the safety net for the very people the bill is theoretically trying to help. But it's not just the banks feeling this, right?
Not at all.
We need to talk about the mall. Because when I read the section on the retail apocalypse, I was honestly shocked. I didn't realize how connected my jeans were to my interest rate.
It is a massive hidden vulnerability in the economy.
Wow.
We're talking about Store-branded cards. Private label credit cards.
The card the cashier asks if you want to sign up for to get 20% off.
That's the one. And those usually have very high interest rates, like 25% or 30%.
Right, because the people getting them are often riskier borrowers.
Yes, or they are younger with thin credit files. But here is the thing. Those cards are absolute cash cows for the retailers. The impact assessment looked at the 2023 and 2024 financial data for major department stores, and the numbers are staggering.
You mentioned Macy's in the notes. Break that down for us.
Okay, let's look at Macy's. In 2023, their credit card revenue wasn't just a nice little bonus on the side. It was 511% of their net income.
Wait, hold on. 511%. That means without the credit card revenue.
Without the credit card revenue, Macy's would have posted a massive operating loss. They wouldn't just be less profitable, they would be bleeding money.
So effectively, Macy's isn't a department store anymore. It's a bank that decorates its lobby with clothing.
That is a very, very accurate way to put it. The retail operation is the customer acquisition channel for the credit card business. And it's not just Macy's.
Who else?
Kohl's is similar. Their credit revenue was nearly 3 times their net income. Nordstrom's credit revenue was 3.5 times their net earnings.
So these iconic American brands are propped up by high-interest store cards.
They are. So
Yeah.
if this 10% cap passes, and the banks look at the math and say, we can't support these high-risk store cards at 10%.
And the banks terminate the programs. They cut the cord.
And suddenly, the retailers lose their primary profit engine. The sources suggest this would lead to a new wave of store closures and job losses, mirroring the retail apocalypse we saw in the 2010s, but maybe even faster.
It just pulls the rug out from under their whole business model. And speaking of fragile ecosystems, we have to talk about rewards.
Ah, yes.
I feel like everyone listening probably utilizes points or cashback in some way. I use my 2% cashback card for everything.
Well, under this bill, you can probably say goodbye to that.
Just like that, even the 1.5% cards.
It goes back to the margin. If the bank is making zero profit or losing money on the transaction, there is no budget for customer acquisition. Rewards are marketing.
The Vanderbilt study estimates a $27 billion reduction in rewards.
Which is nearly all of them. The math just doesn't support giving you 2% back if they aren't making any money on you. And it's not just cash back.
Airline miles.
Airline miles, hotel points. Think about how many people fly Delta or stay at Marriott strictly because of their point status. Those loyalty programs are funded by interchange fees and interest margins. If the margin disappears, the miles disappear.
That changes the vacation plans for a lot of people.
Yeah.
But there is another modern financial tool that gets caught in this net buy now, pay later.
The Pay in 4 apps.
Right, like Affirm or Klarna. I see those buttons on every checkout screen now.
This is a fascinating legal trap, and it shows how broad the bill's language is. The Consumer Financial Protection Bureau recently classified those digital user accounts as credit cards for regulatory purposes.
So this 10% cap legislation applies to them.
It does.
But buy now, pay later is usually 0% interest. If you pay in 4 installments, it's interest-free. So they're already well under the 10% cap. Why would this bill hurt them?
The problem is that transactor paradox again. Remember Section 107, F2. The total sum of fees may not exceed the finance charges.
Right, so if the interest is 0.
The fees must be 0.
But BNPL companies don't charge interest. They charge late fees. That's how they protect themselves.
Correct. Late fees are their primary enforcement mechanism.
Right.
So under this bill, since they charged you 0% interest on the purchase, they are legally banned from charging you a late fee. They can't penalize you.
So, if I don't pay my last installment, nothing happens.
Financially, they can't extract a penalty, which means the entire risk model breaks. You can't lend money to strangers on the internet with no interest and no ability to penalize non-payment.
It would effectively regulate the current BNPL model out of existence.
That's what the sources suggest.
It seems like every time we pull a thread on this bill, something else unravels. But has this actually happened anywhere? I mean, is there a real-world test case?
There is. Japan.
Japan.
Yes. The sources point to Japan's money-lending business law reforms between 2006 and 2010. They had a similar political movement to lower rates.
And what did they cap it at?
They lowered the rate cap to 20%, so not even as aggressive as 10%. A much milder cap.
And what happened?
The results were stark. The legal consumer finance market shrank by 60%. Acceptance rates for loans crashed from 50% down to 26%.
So the banks just stopped saying yes.
They had to. But here is the critical lesson for us. The demand for money didn't disappear. Just because the bank says no doesn't mean your car didn't break down. So the need for credit moved. to the Yamakin.
The Yamakin. That sounds ominous.
It translates roughly to dark finance. It's the underground loan sharks. Police data showed a sharp rise in victims during this period. People who were rejected by the legal banks were desperate, so they went to illegal lenders.
And I assume the Yamakin aren't following the government's 20% cap.
Far from it. They charged astronomical rates, sometimes 1,000%, and used aggressive, sometimes violent collection tactics.
So the attempt to protect consumers from high rates actually pushed the most vulnerable people into the arms of criminals.
That is what the historical data shows. When you price fix a market below the cost of doing business, the legal apply vanishes. But the demand creates a black market.
That is a sobering precedent. Before we wrap up, I want to touch on the risks to the banks themselves, because the bill has some serious teeth regarding penalties.
Keith is putting it mildly. It creates a strict liability standard.
Explain strict liability for us non-lawyers.
It means intent doesn't matter. If a bank violates the cap, even by accident, maybe a computer glitch calculates a fee wrong by 1 cent. The bill mandates forfeiture of the entire interest on the note.
Wait, the entire interest, not just the overcharge?
All of it. The entire loan's interest is forfeit. It's like stepping on a crack in the sidewalk and being fined the value of the entire sidewalk.
That seems incredibly harsh for a clerical error.
And it gets riskier. It gives consumers a private right of action. This means you can sue to recover all interest and fees paid. And the look-back period is 2 years.
So if a bank messes up, they could be on the hook for refunding 2 years of revenue to a whole class of customers.
Correct. And that creates what the sources call an uninsurable environment. The risk of a class action lawsuit is so high that lenders will be even more conservative. They won't aim for 10%, they'll aim for 8% or 9% just to be safe.
Which restricts credit even further. So what does this all mean? We started with a simple idea, capping rates at 10% to help working families.
A noble goal. No one likes paying 25% interest. But if we synthesize all these sources, the bill text, the bank math, the retail data, the history in Japan, the conclusion points in a very different direction.
It sounds like it might achieve the exact opposite of what it intends.
The structural mechanics suggest that instead of 10% rates for everyone, we end up with 10% rates for the wealthy, the people who don't really need credit, and zero access for everyone else.
The people who need the bridge the most get the bridge cut off.
Precisely. And the destruction of the rewards ecosystem and the retail profit model are just collateral damage in that process.
It leaves us with a really provocative question to chew on. If this passes and legal credit becomes unprofitable for the working class, where does that demand go?
It has to go somewhere. People still need liquidity.
Does it disappear? Or do we see a version of what happened in Japan where the demand moves into the shadows? If you can't get a credit card to fix your car so you can get to work, do you just not go to work? Or do you find money from a source that doesn't follow House resolutions?
That is the question we have to ask.
Oh.
When you turn off the light switch on the legal market, you might just be leaving people in the dark with something much worse.
Something to think about. Thank you for listening to this analysis of the 10% credit card interest rate cap act.
Thank you.
See you next time.